stop scrolling right now, because what I'm about to tell you could save you hundreds of thousands of dollars or cost you everything you've worked for. The Australian housing market just shifted into a completely new phase. And I'm not being dramatic when I say that most Australians, most investors, most first home buyers, and yes, even most real estate agents completely missed the signal. Before we dive into this critical information, I need your help. I've been pouring hours into researching this content, analyzing the data, speaking to economists, and breaking down complex market signals so you don't have to. But here's the truth. This channel is struggling to grow. If you find value in what I'm sharing today, please hit that subscribe button right now. It costs you nothing, but it means everything for this channel's survival. I promise to keep bringing you the real information that mainstream media won't tell you. Just tap subscribe and let's grow this community together. Now let me show you exactly what's happening, because once you understand this signal, you'll see the market completely differently. 3 weeks ago, something happened in the Australian property market that barely made headlines. The Australian Bureau of Statistics released their latest lending indicators data, and buried within page 47 of that report was a number that made me stop cold. New investor loan commitments didn't just slow down, they diverged from owner-occupier lending for the first time since 2019. Now I know what you're thinking. Loan data? That's boring. But here's why this matters more than any auction clearance rate or median price figure you'll ever see. Investors lead the market. They always have. When investors pull back while owner-occupiers push forward, it creates a specific market condition that has preceded every major correction in Australian housing history. I went back through 30 years of data. In 1989, we saw this exact divergence pattern 4 months before prices peaked. In 2008, we saw it 6 months before the global financial crisis hit our shores. In 2017, we saw it right before APRA stepped in with lending restrictions. And now, in 2024, we're seeing it again. This is Phase 2. Phase 1 was the post-pandemic boom, where everyone made money and everyone thought they were a property genius. Phase 2 is where the smart money quietly repositions, while everyone else is still celebrating gains from 18 months ago. Let me explain exactly what Phase 2 means, because there's a lot of confusion about how property cycles actually work in this country. The Australian housing market doesn't crash like American markets. We don't have those dramatic 50% falls that make international headlines. Instead, our market moves through phases, and understanding which phase we're in determines whether you build wealth or destroy it. Phase 1 is expansion. This is when credit is flowing freely, sentiment is high, auction clearance rates are above 70%, and everyone from your barista to your Uber driver has an opinion on property investment. We just finished Phase 1. It ran from mid-2020 through to late 2023. Phase 2 is what I call the divergence phase. This is where we are right now. In this phase, the headline numbers still look okay. Prices might even still be rising in some areas. But underneath the surface, the composition of the market is changing. Investors start pulling back. Days on market start extending. The gap between asking prices and selling prices starts widening. Vendors who need to sell start accepting lower offers, while those who don't need to sell just pull their listings. Phase 3 is correction. This is where prices actually fall in nominal terms, not everywhere at once, but spreading from the overheated suburbs outward. Phase 4 is capitulation. This is where forced sellers enter the market. Banks start getting nervous about their loan books, and real opportunities emerge for those who prepared during Phase 2. The critical thing to understand is that Phase 2 can last anywhere from 6 months to 3 years. We're approximately 3 months into Phase 2 right now. Most people won't recognize we're in this phase until Phase 3 is well underway. Let me show you the specific data points that confirm we've entered Phase 2, because I don't expect you to just take my word for this. First, let's look at investor lending. In the 12 months to November 2023, investor loan commitments grew by 24.7%. Sounds strong, right? But in the 3 months to February 2024, that growth rate collapsed to just 4.2% annualized. That's not a slowdown. That's a complete change in behavior. Second, look at the loan-to-value ratios. The proportion of loans written at above 80% LVR has dropped from 31% to 23% in just 6 months. What does this tell us? It tells us that banks are quietly tightening their actual lending practices, even though official serviceability buffers haven't changed. Banks see something in the data that's making them nervous. Third, examine the rental market. Everyone points to record low vacancy rates as proof of housing strength. But here's what they're missing. The rate of rental growth is decelerating rapidly. In Sydney, annual rent growth peaked at 14% in mid-2023. The latest data shows it's now running at just 6%. Still growth? Yes, but the trend is unmistakable. The rental market that was supposedly supporting property values is losing steam. Fourth, consider the construction pipeline. We have the lowest number of residential building approvals since 2012. Basic economics tells us this should support prices through supply constraints. But here's the problem. We also have the weakest population growth forecast for the next 3 years since the early 1990s, because the government is finally tightening migration policy. The supply shortage and the demand outlook are moving in the same direction. Fifth, and this is the signal that really got my attention, look at the mortgage offset account balances. Australians have collectively pulled over $4 billion from their offset accounts in the past 9 months. After building up record buffers during the pandemic, households are now burning through those savings to meet cost of living pressures. When mortgage holders draw down their buffers, they're telling us something about their financial stress that no survey or sentiment indicator can capture. Not all property markets are created equal, and Phase 2 will impact different areas in very different ways. Let me break down where I see the biggest risks and where there might actually still be pockets of opportunity. The outer suburbs of Sydney and Melbourne are ground zero for this phase. I'm talking about areas like Marsden Park, Oran Park, Clyde North, and Tarneet. These areas saw massive price gains during Phase 1 because they offered relatively affordable entry points for first home buyers using government grants and low deposits. But these suburbs have a problem. They're filled with borrowers who stretched to their absolute maximum to get into the market. When I look at the mortgage stress data from Digital Finance Analytics, these postcodes light up like Christmas trees. Over 40% of mortgage holders in some of these areas are now classified as experiencing mortgage stress, meaning more than 30% of their gross income is going to housing costs. The premium end of the market has a different dynamic, but still faces Phase 2 pressures. In the 2 million plus bracket in Sydney and Melbourne, we're seeing days on market extend from an average of 23 days during Phase 1 to 38 days now. Stock is accumulating. Buyers at this price point are more sensitive to interest rates because their mortgages are larger in absolute terms. A $2 million loan at current rates costs over $12,000 per month in repayments. Regional markets that boomed during the work-from-home migration are particularly vulnerable. Towns like Ballarat, Bendigo, Geelong, Wollongong, and the Gold Coast hinterland saw price gains of 40 to 60% in just 2 years. But here's the reality. Many of those tree change and sea change buyers are now being called back to offices at least part-time. The value proposition of a 90-minute commute looks very different when you have to do it 3 days a week instead of never. Brisbane and Perth are interesting outliers. They entered the boom later than Sydney and Melbourne and still have genuine supply constraints combined with strong employment markets. I would argue these cities are still in late Phase 1 rather than Phase 2, but they're not immune. They're just on a delayed timeline. Now I need to address the elephant in the room: interest rates. Because so much of the property market narrative right now is based on this assumption that rate cuts are coming and they'll save the market. Let me give you the reality check. The Reserve Bank of Australia is in an impossible position. Inflation is still running above their target band. Employment remains stronger than they expected. Productivity is weak. And the Australian dollar is under pressure, which is importing inflation through higher costs for everything we buy from overseas. Yes, the market is pricing in rate cuts starting late 2024. But the market has been wrong before. Remember, when the market was certain rates would never go above 1%? Remember, when the RBA said rates wouldn't rise until 2024 and then raised them in May 2022? Here's my base case. Even if we do get rate cuts, they will be slow and shallow. We might see 50 to 75 basis points of cuts over 12 to 18 months. That's not enough to materially change borrowing capacity or reignite housing demand. The emergency rate settings of 2020 and 2021 are not coming back in our lifetimes, barring another pandemic-level crisis. More importantly, rate cuts typically signal economic weakness. The RBA won't cut rates because everything is going well. They'll cut rates because unemployment is rising, growth is weakening, and confidence is falling. Those conditions are not supportive of property prices. I've analyzed every rate cut cycle in Australia since 1990. In 6 of those 8 cycles, property prices continued falling for an average of 11 months after the first rate cut. The exception was 2019 to 2020, but that cycle was interrupted by a literal global pandemic that changed everything. So, what should you actually do with this information? Let me share what I'm seeing sophisticated investors and well-advised families doing right now. First, they're building liquidity. The smartest investors I know are not buying aggressively right now. They're selling underperforming assets, reducing debt, and building cash positions. They understand that Phase 2 is about preparation. The best opportunities come during Phase 3 and Phase 4, when distressed sellers emerge and competition dries up. Second, they're renegotiating their existing mortgages. If you haven't contacted your lender in the past 6 months, you're almost certainly paying too much. Banks are hungry to retain good customers and will often cut 20 to 40 basis points off your rate if you threaten to refinance. That might not sound like much, but on a $500,000 loan, it's $2,000 a year. Third, they're focusing on cash flow over capital growth. The properties being purchased by smart money right now are high-yielding assets in areas with genuine rental demand. They're not chasing potential appreciation in hot suburbs. They're buying boring properties in boring locations that generate positive cash flow from day one. Fourth, they're getting pre-approved and ready to move fast. Phase 3 will create genuine opportunities, but they won't last long. Having finance pre-approved, conveyances on standby, and clear criteria for what you'll buy means you can act within days when the right property appears. Fifth, they're ignoring the noise. Every week brings a new headline about property prices. Record highs here, surprise falls there, expert predictions everywhere. The smart money ignores all of this short-term noise and focuses on the fundamentals: population, employment, income growth, and credit conditions. These factors move slowly, but they ultimately determine property values. Now, I want to balance this analysis because I don't want anyone to walk away thinking the answer is simply to wait forever. Markets are complicated, and there are real risks to sitting on the sidelines indefinitely. The first risk is that I'm wrong. Phase 2 might be shorter than I expect. The government might announce unexpected stimulus. Migration might accelerate again. Global capital fleeing instability elsewhere might flood into Australian property. Humility about the limits of prediction is essential. The second risk is that rents keep rising and you're burning money while waiting. If you're currently renting and waiting for a crash, you need to model out the actual mathematics. If rents rise 10% per year and property prices fall 5% per year, it might still make sense to buy, depending on your specific circumstances. The third risk is that not all properties will correct equally. Some areas might power through Phase 2 without meaningful price falls because of genuine supply constraints or exceptional demand drivers. If you're waiting for a 40% crash in Mosman or Turak, you'll likely be waiting forever. The fourth risk is that your personal circumstances might change. Job losses, relationship breakdowns, health issues, or family needs can force you to buy or sell at the worst possible time. Sometimes taking action when conditions are merely okay is better than waiting for perfect conditions that arrive when your life is in chaos. I usually avoid making specific predictions because markets are inherently unpredictable. But I know many of you want to know what I actually think will happen, so let me share my base case scenario. I believe Phase 2 will last approximately 18 to 24 months. During this time, headline price growth will slow to zero or slightly negative on a national level. Some markets, particularly Melbourne and the outer suburbs of major cities, will see price falls of 10 to 15%. Premium markets will see smaller falls but longer selling times. Brisbane and Perth will flatline rather than fall. I believe Phase 3 will begin sometime in 2026, triggered by either a global recession, a sharp rise in unemployment, or an unexpected credit event. This phase will see genuine distress in the market with forced sales, mortgagee auctions increasing, and genuine fear among property owners. I believe Phase 4 will create the best buying opportunity since 2019 for those who are prepared with cash and pre-approval ready to deploy. I could be completely wrong. My timing could be off by a year in either direction. But the overall framework that we're in a cyclical transition that will create both risks and opportunities, I'm confident in that fundamental analysis. Listen, I've given you a lot of information today, probably more than you expected when you clicked on this video. But I want to leave you with this thought. The Australian dream of homeownership is not dead. Property will continue to be a fundamental part of wealth building in this country. But the easy money has been made. The next phase of the market will reward preparation, patience, and a willingness to see what others refuse to acknowledge. If you found this analysis valuable, I need you to do something for me. Subscribe to this channel right now. Hit the notification bell so you don't miss my updates as Phase 2 develops. Share this video with someone you care about who might be about to make a major property decision without understanding what's happening in the market. I'll be back next week with a deep dive into the specific suburbs I believe offer the best risk-adjusted opportunities in the current environment. Until then, stay